I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Tuesday, September 5th. To view our full range of trading services and publications, visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. I trust you enjoyed your Labor Day holiday. I operated the gas grill, enjoyed my favorite libation, cold Sam Adams beer, and tried to forget Wall Street for a couple of days. But, well, it's Tuesday and vacation is over. Unofficially, summer is over too. However, the topic of American labor continues to loom large over the stock market. This past week, key reports on the U.S. jobs market conveyed signs that the economy is decelerating after an extended period of rapid gains. The cooling of jobs growth increases the odds that the Federal Reserve will hit the pause button on its interest rate tightening cycle when the central bank next meets September 19 to 20. A pause, of course, would be a bullish catalyst for the stock market. A softening labor market and economy are likely to put downward pressure on U.S. Treasury yields, which in turn would benefit interest rate sensitive equities in such sectors as technology. That said, we just closed the books on a dismal month. The main U.S. stock market indices slumped in August as follows. The Dow fell 2.4%, the S&P 500 fell 1.7%, the Nasdaq minus 2.2%, and the Russell 2000 fell 5.4%. However, stocks kicked off September on a positive note and finished last week higher. The Dow rose 1.4%, the S&P 500 rose 2.5%, the Nasdaq rose 3.2%, and the EAFE, which measures stocks in developed countries excluding the U.S. and Canada, rose 2.7%. Crude oil prices jumped an impressive 7.6% last week amid tight supplies and optimism over the economy. The U.S. Bureau of Labor Statistics reported last Friday that total non-farm payroll employment increased by 187,000 in August versus 170,000 estimated. The unemployment rate rose to 3.8%. The data showed a cooling but still resilient jobs market. Softer employment numbers are likely to translate into dampened consumer consumption. Rate hikes are starting to take their toll as the inflation fighters planned, but the economy doesn't seem on the verge of a recession. The current betting on Wall Street is that these Goldilocks conditions will prompt the Fed to not only pause this year, but actually start to cut rates in mid-2024. Look, it's usually a fool's game to make predictions that far into the future. But the trend is clear. The Fed is nearing the end of tightening. History shows that stocks surge in the immediate wake of a Fed cut. High interest rates adversely affect discounted cash flow valuations, which can hurt high-growth stocks, particularly in the technology sector. When the Fed gets dovish, which is expected to happen sometime around May 2024, risk-on growth stocks will be embraced again with confidence. The federal funds rate currently hovers at 5.33%, as you can see from this chart. The Fed hiked interest rates by 25 basis points to between 5.25% and 5.50% at its July 2023 meeting. Over the long term, the Fed funds rate is projected to trend around 4.75% in 2024 and 3.75% in 2025. The confluence of factors is supporting the stock market's momentum. The S&P 500 currently hovers above its 50 and 200-day moving averages, which tells us that the prevailing trend is bullish. Likewise, the New York Stock Exchange Advanced Decline Line, the NIAD, also hovers above its 50 and 200-day moving averages. The NIAD tells us how many stocks are participating in a stock market rally or decline. Right now, the rising NIAD signals healthy market breadth. Now let's take a look at the week ahead. Here are the major economic reports scheduled for release during the holiday-shortened week. Factory orders Tuesday. S&P final U.S. Services PMI, ISM Services Fed Beige Book Wednesday. Initial jobless claims speeches by various Fed governors Thursday. Can't wait for that. Wholesale inventories, consumer credit Friday. Despite these positive trends, September historically has been the worst month for stocks. I hate to tell you that. We'll see if last week's gains were the start of a new leg up for the stock market or a last hurrah before the autumnal doldrums set in. But you can still make money in up or down markets by heeding the advice of my colleague, Jim Pierce. Jim Pierce is the chief investment strategist of Mayhem Trader. Jim doesn't worry about market mayhem. He methodically makes money from it. Jim has developed an under-the-radar strategy to flip market mayhem into fast payouts. Want to learn more? click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or questions, please don't hesitate to send an email to me at mailbag@investingdaily.com. Well, that's it for now. Thanks so much for watching.